Hi, Lori. You need to unmute.
There we go. Yep.
There we go. Oh, now we got a few more people. Good to see you, Lori.
You too.
Taylor, how you doing? Pray tell, what happened to Taylor? There she is. How you doing, Taylor? You're muted.
Oh, here I am.
Here we go. Is this Alco? I can't hear you, Alco. Okay, well, we have 4 people. We could probably get started in a minute here. Have you all gone through chapter 1 a little bit?
Yes.
Just an introduction, what the financial statements are like. What we're going to do now in chapter 2 is run through a whole bunch of transactions demonstrating how the accounting equation is always kept in balance. And we're going to use words like increase, decrease, up and down. And then when we get to chapter 3, that's where we're going to introduce the same transactions using the proper accounting terms, debit and credit. And chapter 3 is really where the rubber hits the road. But if we get a good understanding of how the accounting equation is balanced through different transactions and what some of these terms are, I think that'll put us in pretty good shape. So without further ado, let's see if I can share the screen here. I think I see it. And let's go here. Chapter 2. Let me do my Sheldon Cooper thing where I have to set this up my way. Okay, here we go. It's Martin Luther King Day. I don't know if you call it a happy day. He was, what a great American. Here we go. Accounting transactions, the accounting equation. A business entity is any organization trying to make money selling a product or a service. I think we kind of know that. And the important point they're making in the second bullet here is sometimes a business is small and an owner takes money out of the business for their own personal needs, which is perfectly legitimate. But those transactions need to affect the company as well. And we're going to talk about that in a moment here. The owner of the business may have assets as well as other non-business. Non-business are not included. What we're really talking about here is something called drawing. Small business, you walk out, you're the boss. You say to me, hey, Bob, give me a check for $200 right now. And I say, yes, boss. What's it for? Because I need to know how to code it. And you say, well, I'm taking the wife and kids out to dinner tonight. That's a personal expense and needs to be recorded as such. Assets, anything good that we own, we know what assets are, right? Assets, cash, merchandise, which is inventory, furniture, fixtures, the lights, the walls, Accounts receivable. Let's go over these a little bit now. Accounts receivable. This is the money that your customers owe you at that point in time, okay? Accounts receivable. If you see a number on your balance sheet, that number is $10,000. That means altogether your customers owe you that amount at that point. Liabilities are the opposite. These are monies we owe to somebody else. A liability is a debt. It is an IOU. It's a promise to pay. Accounts payable, that number on our balance sheet is going to represent the number of dollars that we owe to our vendors, meaning our suppliers, the people who sell us our inventory, the insurance companies, the utility companies, etc. Accounts payable, what we owe to vendors. Accounts receivable, what customers owe to us. One man's accounts receivable is another woman's accounts payable. Notes payable are debts we incurred by borrowing. They are not accounts payable. Accounts payable are to suppliers. Accounts payable, an unwritten promise to pay. You're making a purchase on account. You're going to see those words come up now as we do transactions on account. Say to yourself, on account of nobody had money. That's how I teach it. On account of nobody had money. What this means is if you purchase something on account, well, you're going to get your merchandise delivered to you. So your asset goes up, the inventory, but you haven't paid for it yet. You have not paid for it yet. So that becomes accounts payable. And really don't confuse accounts receivable and accounts payable, which is very easy to do, especially where you start to get a little bit comfortable and maybe go a little bit too fast sometimes. Are we waiting to receive or waiting to pay? Waiting to receive, waiting to pay. Notes payable. Notes payable. Here is a borrowing situation. We borrowed money in order to get money to pay. We might have gone to somebody and said, can we buy this product from you? And they said, no, we don't trust you, but we will sell it to you if you're willing to sign a note. And a note means that you promise to pay plus some interest. Owner's equity, the net worth of the company. It could be called capital. It's going to be called stockholders' equity. Liabilities, let me start again. Assets equal liabilities plus equity, right? So assets minus liabilities is the net worth of the company. If you have $1,000 in assets and you have $600 in liabilities, your company's net worth on paper is $400. Let's see what this, I don't like these busy screens when they pop up. Next time you buy something, think of all the assets. If the product comes from a key, I'll read it. Next time you buy something, think of all the assets a company needs to produce that product. If the product comes from a capital intensive inventory business, company must price the product high enough. You know what? This is a bit of jargon here that I'm going to ignore. I don't think it's a particularly useful screen, okay? Construct the accounting equation. Assets equals liabilities plus equity. I think we know that. Assets are on the left. Liabilities and owner's equity are on the right. If a business has total assets of $60,400, total liabilities of $5,400, what is the owner's equity? Well, once the debt is paid, the remaining assets, belong to the owner. That's what the business is worth. So here, the accounting equation tells us that the assets minus those liabilities equal the net worth of the company. The accounting equation must always remain in balance. And I don't think you're ever going to run into that problem in the working world doing it with a computer. No system is going to allow you to post an out of balance journal entry like I occasionally did when we did it in pencil, right? So we're going to look at a few transactions here. Business transactions, an economic event that affects the business. Who knew? It could be we sold a product. It could be we bought something, we paid somebody. And most of these transactions, at least the ones we're going to see here, deal with an outside entity, meaning it affects not just us, but an outside independent party. For example, you buy something, well, that's a payable to us and a receivable to somebody else. We have to measure it in dollars, huh? And all business transactions Roll through the accounting equations through specific accounts. And these are the specific accounts are your list of assets, liabilities, and equity. So let's see what we have here. You're looking at a business transaction. They're suggesting three questions. What happened? Be able to very simply say to yourself, what transpired here? A simple example is you're sitting at your desk and the electric bill arrives in the mail, and the electric bill is $800. Well, what happened was you got the electric bill and you're going to have to pay it. So you're going to look at that electric bill. You're probably going to compare it to prior months to see if it's consistent and makes some sense. And once you ascertain that it's a reasonable number, now you're ready to say, I'm ready to record this. What accounts are affected? Well, in our example here, the electric bill, well, that's an expense. Electricity is clearly an expense. And we're probably not going to pay it right now. We're going to pay it later. So a liability would go up. So those would be the accounts: electric expense and accounts payable. And then determine which accounts have increased or decreased. Now, going forward into chapter 3, we'll be talking in terms of what gets debited and credited. Those words are not in our vocabulary just yet, but I want to throw them out there. Make certain that the accounting equation remains in balance. Show the effect of transactions, okay? Mitchell Campus Delivery, whatever he does. Okay, Mitchell Williams, sole proprietor, okay? He invested $5,000 in a new business. So the first question they want us to ask is, what happened? Well, he invested $5,000 in a business. He took money out of his own personal bank account and put it into a bank account in the company's name. So what's happened here is cash is going to be affected, as is the capital of the company. Capital of the company. Clearly classify these accounts as assets, liabilities. In this case, it would be an asset, owner's equity, which goes up and down. Cash went up, so did the capital. There was no capital, there was no business. So now this guy put in $5,000, and let's look at the very simple start with the accounting equation. After his first moment of business, the moment his business started, here's what his financial records look like in simplified form. He had cash, no liabilities, and they're calling his owner's equity. You can also call it owner's investment, or Mitchell Williams Capital is probably how it's going to be in your chart of accounts and listed on your balance sheet. Okay, well, let's go. He purchased an asset. He bought delivery equipment for $2,000 in cash, huh? Well, now we have a new asset, huh? We bought a scooter or a truck or something, and we paid for it with cash. So clearly we have cash involved and we have delivery equipment, and we know cash is an asset and so is delivery equipment. So what we've done here really is just swap assets, if you want to say it that way. Cash has been decreased. The equipment is increased. We're still in balance. And they're using the expression traded one asset for another. And that happens all the time. You collect money from a customer, your asset accounts receivable goes down and your cash goes up. One asset increased and another decreased. So let's take a look at what we have here. After the second transaction, we still have $5,000 of assets, which equals the equity because we have no liabilities. So this company is still worth $5,000 on paper. It's just that they have different mix of assets, okay? Purchased an asset on account. Remember what I said? On account, nobody had money. As soon as you see those two words, you say to yourself, on account of nobody had money in this transaction. The money will come later. So they bought an asset, huh? They bought an asset. They bought more delivery equipment. but this time it's on account. So there's no cash. We have more delivery equipment, but now we have accounts payable, because we're going to pay it later. Take a look now. Now our assets have grown to $6,800, but our equity remains the same, $5,000, because now we have this interloper here. We have the $1,800 in accounts payable. So this company has $3,000 in cash available to pay the $1,800 if they want. They've got $3,800 in equipment. Now it looks like this guy's ready to do some deliveries, perhaps. He paid part of a loan. He paid the first installment on the scooter of he bought this thing for $1,800. He didn't borrow the money. They're saying that he borrowed it. He's really paying $600 down. That's a bad way to express it. Paid the first installment on the scooter. He owed $1,800. He's going to pay 1/3 of it now, right? So what happens here? We have cash and accounts payable. Cash is an asset, accounts payable, a liability. Let's see what happened here. Cash went down, and so did the accounts payable. We should still be in balance. Cash went down by 6. Payable went down by 6. So let's take a look. Cash paid $600. So he has $2,400 left in the bank. He still has the delivery equipment. So now his assets have gone from $6,800 to $6,200. The accounts payable went down $600. So he only owes $1,200 now, and the equity has not changed. The equity has not changed. The equity will not change until we do something with the income statement. Little hint. And here we go. Revenues. What are revenues? Revenues and sales. Same meaning, same thing. Revenue, sales. In this case, they could be delivery fees, consulting fees, rent revenue. Revenues are revenues, okay? There's just different types of revenues. You could have sales of a product, sales of a service, all kinds of things. And here's a key rule right here. The revenue is recognized when it's earned. It has nothing to do with the movement of the cash. It can, but the revenue is recorded when you make the sale. We don't care if we've been paid yet. That's called accrual accounting. We are recognizing revenues and expenses when they're incurred. So we have revenue, and that's probably going to increase assets. We're either going to get paid right away, cash or accounts receivable, and we're going to record some kind of revenue account. Expenses have the same thought process. These are recognized when they're incurred. That electric bill that came to you on December 31st, well, on December 31st, you're not going to pay it now. You're going to record the expense, though, because you have incurred it. Expenses will always reduce a company's equity, and a revenue will always increase it. Okay, that's just a real broad stroke. Revenues are increasing equity, expenses lower equity. What you're going to learn, though, is you don't move it into the balance sheet until the end of the period, that net profit. That's coming up in our next chapter, I believe, or chapter 4. This is an accounting concept. We talked about the acronym GAP, Generally Accepting Accounting Principles. This is one of them, the period concept. And it simply means that a business can be analyzed in terms of a finite period of time. Most companies every month go through this concept. Every month, they analyze what they've done, they prepare financial statements, and they get a good understanding of what their business did this month, how it compared to prior months. They've got a good idea of what the forecast looks like, and they do it every month for the most part. Any 12-month accounting period is called a fiscal year, huh? Fiscal year, that's a nice word to know, fiscal. It's an accounting period. It has nothing to do with the calendar year. It can be the same, but it doesn't have to be. For example, you're going to be given, oh, not in this class, but in my 230 class, they get an assignment where they compare. This semester, I'm probably going to give them Kellogg's and General Mills, the big cereal producers and distributors. Their fiscal year begins in May, I believe, because that matches the harvest season. These are old farm grown businesses. So their fiscal year goes from, I don't know, May 31st to April 30th. Nordstrom's and department stores, they often start their fiscal year on September 1st because they want to scoop up those last month's sales in December, their busy period. Well, I don't think we have to go over this one too much. Net income. If you had revenues of 9,000 and your expenses were 5, net income, you made money, huh? Revenues over expenses. I don't think that's too tough. What if the company's expenses are higher than the revenues? Well, they lost money. They lost money. Do companies do that? Yes, they do, more frequently than you could ever imagine, huh? Okay, here's something new. Withdrawals. This is the account we're going to use to lock up and record personal expenses of the ownership, okay? What we're saying here, everybody, is you came to me and you took $200 from the company. You told me you're taking your family out for dinner. That's a personal expense. That personal expense immediately reduces the company's equity and assets. And we're going to call this drawing. It's called owner's drawing, owner's withdrawal. So I think we're probably going to see a look at it here. Look at your assets. We have the cash. We're working with those same numbers. The cash and the delivery equipment add up to 6,200. Our liabilities total 12, and our equity is 6. Notice what they've done here, though. They have now inserted Mitchell Williams drawing. And you notice that it's a minus. Capital goes up when we sell something or make a profit. Capital goes down when Mitchell takes money out of the company for his own purposes. And notice that they've added 2 other things here now. The earnings, net income, revenues minus expenses. Okay? So you might call this the expanded equation, but it's really the same. Assets equal liabilities plus owner's equity. What affects owner's equity? Monies that are contributed to the company. Mitchell Williams put his own money in a business. We call that contributed capital. It's one element of ownership, minus any drawings, plus revenues, minus expenses. And another word for revenues minus expenses is income, net income. And what you're going to learn is throughout the month, this equation is going to be filled out. And it's only at the very end of the month that we move these revenues, expenses over to the capital. So we've expanded it now with revenues, expenses, and withdrawals. Revenues increase ownership, and drawings and expenses do the opposite. Okay, so now we're going to start to get into some transactions that feed the income statement, okay? Mitch received $2,100 cash from clients. He went out, made some deliveries, and they handed him a check. Well, what's happened here? Cash is affected. Well, when you are dealing with your clients, you provide services, that's the revenue. So cash is going to go up. Revenues in the form of delivery fees will also go up. How does it affect the accounting equation? Well, let's see. Assets go up by 2,100, and so does revenue. So let's take a look at our equation here. Want to get this thing out of my way. Thank you. Take a look at this now. He now received $2,100 in cash. Assets have gone up to 8,300 now. Liabilities. Now look at capital. Notice it did not change, right? Well, what did I just say? I said revenues increase capital and expenses decrease. And that's 100% correct. What you're going to be learning is, that these revenues and expenses are going to get zeroed out at the end of the month and then used to increase that. Let me say it this way. If this was the end of the month and there were no other transactions, the income would be 2,100. This would be going away and moved over to the 5,000, increasing that. Getting ahead of us just a little bit. Here we go. He had to pay rent. He had to pay the rent. Well, I'm pretty sure he paid it with cash, and rent is an expense. So an expense went up and an asset went down by 1,000, huh? Look what happened to owner's equity. Looks like that's going down too. And here we go. Transaction F. Cash down 1,000. Expenses went up 1,000, which means that owner's equity went down by 1,000. So getting real familiar with this little grid here is going to be very helpful when you get into chapter 3. Paid the phone bill. Well, the phone bill came in the mail and Mitch said, I'll just pay for it right now. It's only $100. So what happened? What's affected? Cash and phone expense. Cash goes down, that expense increases. Are we still in balance? I believe we will be, huh? Here we go. Cash went down $100 and the expense went up $100. So now he has revenues of 2,100 versus expenses of 1,100. So right now his profit is $1,000, and that will eventually be brought over to the capital at month end. Uh-oh, here's those two words again. On account of nobody had money, no cash. As soon as you see on account, you know there's no cash involved. You also know that you're very likely going to hit either accounts receivable or accounts payable. Accounts receivable or accounts payable. Which one is affected here? We sold something. That's accounts receivable. This customer now owes us $2,400. Cash wasn't received yet. So that asset cash can't be increased, but accounts receivable can be. So we're going to increase accounts receivable, the asset, and we're going to increase the revenue, which at the end of the month will increase the owner's equity. This thing's starting to fill up nicely, huh? Accounts receivable, 2,400. Revenues up 2,400. Revenue is recognized when it is earned, even though cash is not accrued, is not received, not received. I'm going to just take a little sidetrack here for just a moment. We are teaching what's called accrual-based accounting. Accrual, ACC110 accounting. And that simply means that revenues and expenses are recorded at the time they are incurred. Has nothing to do with the cash. Accrual accounting is GAAP, GAAP, generally accepted accounting principles. All financial statements prepared for bankers, for the public, for investors, for lenders, whoever, have to be done on an accrual basis. Now, you may in the work world hear somebody say, oh, I run my place on a cash business. Anybody who is actually running their business on a cash business is going to cash business themselves out of business because they're not going to have any idea what their company is truly doing in terms of profitability. Now, a small company can get away with it. My brother-in-law, he runs a little store in Pennsylvania. And at the end of the week, he basically scoops up the cash register and pays himself. Something like that. But he's never going to go out and borrow money. He doesn't even care what his profit is. He just knows he has more cash at the end of the week than he did the week before. But that's an outlier. Purchase supplies, huh? Purchase supplies. Well, this is going to introduce something new to you. Might be a little confusing for a little while, a little moment or two. He purchased supplies. Well, supplies are an expense. I think we'd all agree. Look at this. They're giving us a caveat. Supplies are going to last for several months. That means the $80 we bought today are not going to be used this whole month. Maybe some of them. Supplies are going to last for 7 months. Supplies should be recorded as an asset because they provide future benefits. This really should be called an account called prepaid supplies. So you're looking at your first prepaid account. Prepaid supplies. We bought assets, $80, and we used another asset, cash. So let's look at what we have here now. We have supplies, but it's not an expense. It's an asset. It's an asset until we use the supplies. If we use the supplies next month, that's where the expense goes. And I want to talk about a classic prepaid account. Let's see if they give us prepaid insurance. I'm not worried about prepaid insurance. This is the one I think makes it a little bit clearer. You, on December 31st, you purchased an insurance policy for $12,000. That policy covers the following year. If your business burned down, God forbid, on New Year's Eve, you have no insurance. So at that point, that policy is an asset because it provides future value. So for the next 12 months, you are going to record 1/12 of that premium payment of $12,000 as an expense, and you're going to keep using up that asset account, okay? Just want to get you a little warmed up with the prepaids. Okay, what happened here? Cash receipts from a prior sale on account. Well, let's see. Remember we sold something on account? I see $2,400 here. This customer owes us $2,400, or customers total owe us $2,400. Well, one of them paid the bill. One of them paid off their balance. $1,900 in cash we got for delivery services for the revenues we recorded a month ago. Owner's equity is not going to be affected because we already recorded the revenue last month. All we're doing here is swapping assets now. Our cash, our favorite asset, went up by $1,900 and the receivable went down. Does the accounting equation remain? It's supposed to say, does the accounting equation balance? Your default answer is yes. Okay, so let's take a look. Well, we sold this stuff earlier. This receivable of $2,400, that was mixed in with these revenues, right? Some were for cash and others were on account. On account and nobody had money. Now somebody is paying down their bill. We received the cash, which we like, and the guy no longer owes us the $1,900. Our receivables now are only $500. Revenue is recognized when earned, not when cash moves. Oh man, here's our first 3-line entry, huh? 3 account. Purchased an asset on account, but also made a partial payment. Wow, let's see what we have here. Mitch bought another scooter. He's buying scooters like crazy. He bought a scooter for $1,000. But the guy who sold it to him said, look, you got to pay me $300 now and then pay the balance over the next 4 months. So we're looking at our first transaction that hits 3 different accounts. And how many accounts must be affected in every transaction? 2. That's 2. I don't know if I should tell this terrible joke real quick, but you see my 2 fingers here? That can also be Julius Caesar ordering 5 beers. Anybody get that joke? Roman numeral 5, get it? Anyway, enough of that. He bought an asset on account and made a partial payment. So the scooter is $1,000 asset that this business now has. He spent $300 and agrees to pay the balance. That becomes accounts payable. And notice that the owner's equity is unchanged. And the reason it's unchanged is, as you know now, only revenue and expenses affect equity, excluding the drawing. So let's take a deep breath here. Delivery equipment. Now we have more equipment. Hooray. And we had to spend $300. So cash goes down from $52.20 to $49.20. And now our debt has gone up by $700. Feel pretty comfortable with that, Taylor? What we're doing?
Yeah, it's making sense.
Okay. How about you, Lori?
Yeah, totally.
All right, here we go. Keep rolling. Here we go. Here's the example I was hoping they would show. Mitchell paid for an insurance policy that lasts 7 months. Since the policy provides future benefits, it's got to be recorded as an asset. An asset. It's an asset until we use it. That's when you record the expense when you've used the asset. So right now it's an asset. I mean, somebody could buy that insurance policy from us. We could sell it to somebody possibly. Identify the accounts that are impacted. Well, cash says we paid. Prepaid insurance would be the other one. Does the balance remain? Does the equation remain in balance? Oh, you bet it does. And I'm just going to take us back to the top here. When you see the word payment, that's cash. A lot of students at the beginning, they'll say to me, gee, but it says payment. Does that mean they made the payment now or later? Does it go into accounts payable? No. When you see the word payment, that means cash now. Don't make it any harder than it needs to be, right? So let's take a look here. Now we have another asset. Our assets are growing. We started off just with cash. Now we got people owe us money. We've got prepaid supplies, prepaid insurance, and we used cash. And our equation is in balance. 10,003 equals the total of these guys here. Both supplies and insurance are recorded as assets because they throw off the benefits in the future. Oh, this guy's got to pay his delivery people, huh? He's going to pay them. Well, I bet he's going to pay them in cash. Cash goes down and that expense goes up. Will this affect owner's equity? Absolutely. As soon as you see the word revenue or expense, this is going to reduce the owner's equity. It's a business expense. So here, what we're seeing is they're starting to itemize the expenses. This one is wages expense, okay? So our cash went down by 1650 and our expenses went up. So right now, if you're looking at this company, they have revenues of 45 minus 2750. So I guess they have a profit so far of 1750. So far, he's making some money. And as with other expenses, cash is reduced. And I'm so sorry, I got the happy fingers. As with other expenses, cash is reduced and owner's equity is reduced by increasing the expense. Deliveries made for cash in account. Okay, this is sort of the reciprocal of that purchase we saw a few transactions back. What happened? We delivered $3,500 worth of pizza. And we agreed to just bill $2,600 worth to various customers. The 900 I heard was a pizza delivery to the faculty here, and they didn't trust us. We had to pay it in cash, okay? So that's what we're talking about. Total deliveries with 3,500, 900 in cash, 2,600 in account. So we know it's going to be on account. It's either accounts receivable or accounts payable. Who votes for accounts receivable? I think we all do, right? So let's take a look here. Cash is going up, receivables going up, everything's going up, deliveries going up, equity's going up. What a wonderful transaction. And you notice now they're starting to itemize on the right side the delivery fees as well. This is in case this company might have other kinds of revenue. So the revenues went up and the cash went up 900, and we agree to let these customers pay us next month, 26. Recording these revenues impacts 3 accounts while the equation remains in balance. So now he's got a pretty nice profit going. It looks like he's got, if I'm doing this right in my head, about $5,250 in profits. There's not a bad business, whatever it is. Okay, let's take a look at the withdrawal. The withdrawal. This one's counterintuitive and can be a little tricky until you quite understand what we're doing. Mitchell took $3,000 out of the business for personal expenses. He went to the racetrack, and cash goes down. I'm so sorry. Cash goes down, and look at the owner's equity drawing account. The drawing account went up, and in so doing, it decreased owner's equity. When drawing goes up, it decreases the equity. Accounting balance equation will remain in balance. So let me talk about the drawing a little bit. You can all see those numbers, I take it, right? Clearly. Okay. Drawing. Well, what happened here? Mitchell took $3,000 out. The account called drawing went up by 3,000. But look at your formula. Capital minus drawing plus revenues minus expenses equal the owner's equity. What you're going to learn in the next chapter is that's called a contra account. What it means is capital normally has what's called a credit balance, meaning that capital is increased by putting the entry on the credit side. This is the opposite. So withdrawals by the owner are put in that specific account. They're the opposite of investments. And just like an expense, it will decrease the equity, but it doesn't have anything to do with the profitability of the company. So we've gone through a few transactions. Let's do a little bit more here and take a look at prepare and describe the purposes of a simple income statement, owner's equity statement, and balance sheet. And they have to be done in that order. Income statement, statement of owner's equity, balance sheet, in that order. This I'd like to talk about, the financial statement headings. You go online and you call up anybody's financial statement, you look in your textbook at any page where they're showing financial statements, you're going to see a couple of rules. Well, of course, you're going to see the name of the company, Mitchell Williams Company in our case, income statement, and then the time period covered, or the date of the statement. And that's important. It's either going to be the time period covered or the date. So on the income statement, it's Mitchell's Campus Delivery Company income statement for the month ended June 30th. Because an income statement is not a point in time. An income statement is the accumulation of all revenues and all expenses. It covers the entire month. So it's important to say for month ended. If you put down income statement as of June 30th, you would be 100% wrong, because it's not as of June 30th, it's for the entire month. And we'll talk about that a little more as we keep going here. Wow, let's look at these financial statement guidelines. They're prepared for users not associated with the company, primarily, I guess you would say. You're a big company, you're a Fortune 500 company, or you're listed on the exchange. Yeah, these financial statements are immediately going to be in the hands of investors, lenders, employees are going to be interested, especially if you've got a bunch of company stock in your 401k plan. You really want to know if the company's doing well. Management internally wants to know these things. So you're preparing them for specific people. And they're talking about rules about when you underline or double underline. We're not going to worry about that. As you start putting financial statements together, you'll get in a groove in terms of how to make it look neat with a line here or a double line there. They suggest using dollar signs at the top and the end beneath the ruling. Again, not a hard and fast rule. On the income statement, some companies list expenses from highest to low with miscellaneous listed last. Again, I never saw that done, to be honest with you. Any place where I've ever worked or any textbook I've ever seen or talking to other people, your expenses are listed in the same order as in your chart of accounts, okay? Doing them from high to low would not be a good idea. And one reason is what was high this month might not have been high next month. And if that's the case, you can't really compare the two income statements against each other easily. On the balance sheet, assets are listed from most liquid to least liquid. That is 100% true. Assets are based on liquidity. Liquidity measures the ease with which an asset can be converted to cash. It's liquid. A company has $1 million in accounts receivable, but they don't have enough cash to pay their bills. And they don't want to wait 30 days to collect their accounts receivable. They can go to a bank today with that $1 million of accounts receivable, show it to the bank, and assure the bank, convince the bank that it's good receivables. And the bank will say, okay, I'll take it off your hands for $800,000. And then you collect the $1 million and turn it over. Why would a company do that? Because they're desperate for cash. They're willing to do that. It's called factoring your AR. Liabilities are also listed by liquidity. Let's end up with a look at the relationship on the statements. So when you're doing your homework tonight, there'll be a lot of these transactions like we just saw, okay? And then at the end of the month, you're going to run a trial balance and come up with your income statement. So the income statement reports the profitability for a specific period of time, and it's simply revenues minus expenses. It could be called the profit and loss statement or the operating statement. So here's a very simple income statement. This man had $8,000 in revenues. He had a total of 2,750 in expenses. And he had a profit of 5,250. Boy, that's some profit, huh? That's almost 70%. That's a pretty good return. Those expenses are detailed by wages expense, rent expense, and phone. They put them in here in the order, in numerical order. Now, where did we get these numbers? Does this look familiar? Here are the revenues, and here are the expenses. Wages expense, I see. Delivery fees, etc. It came right off our equation. So that's a pretty simple layout. And notice how they set it up. I think this is a perfect way to lay it out. Revenues, colon, indent a little bit. This could be a bigger company. This could be a company that has delivery fees, It could have other types of revenues. Coca-Cola, revenues, colon, and then you have sales of Diet Coke, sales of regular Cokes. You know what I mean? All kinds of different things. So now the reason we do the income statement first is to get the net income. We must get the net income in order to prepare the statement of owner's equity. The statement of owner's equity. This reports the activities that impacted the owner's equity. So let's see. This is a statement where you take the beginning capital, which in this case was 0, and the guy put in 5,000. I'm so sorry. Total investment was 5,000. We can call this the beginning, really. Okay. So his beginning was 5,000. What do we add and subtract to the net to that? We're going to add the net income of 5,250, and we're going to subtract that $3,000 withdrawal. Beginning equity plus net income minus drawing gives you the ending capital balance of 7,250. What they did here with this 2,250 is they netted these two numbers out, the income and the drawing, and they're calling it the increase in capital. You don't even really have to do that on the statement. You can if you think it looks better that way. But let's understand why we got the net income first, because without it, we can't do this statement. And we can't do the balance sheet until we get the new equity number. The new equity number. This guy grew this business from 5 to 7,200 or 7,250, even after he took out $3,000. So it's a mighty profitable little business. The balance sheet. The balance sheet is the accounting equation. Can you remember that? The balance sheet is the accounting equation. It lists the assets on one side. You get your total assets. Total assets must equal your liabilities plus equity. Your liabilities at the end of the month were 19, and the equity was 7,250. The equity was 7,250. There's your 1,900 in payables, if you're wondering where that number came from. So at the end of the month, his assets were 470, 3,100. These were all pulled from that horizontal detailed accounting equation we work with. Total assets, 9,150. He owes 1,900. 9,150 minus 1,900 is 7,250, which very fortunately equals what we calculated here. Okay? So that's the relationship of the statements. And I call your attention to the date. You see what that says, Taylor, everybody? June 30th. The balance sheet must say as of a specific date. The balance sheet is a snapshot. You're taking a picture. At the end of the month, there was $470 in cash in the bank. At the end of the month, at midnight, this is what customers owed. This is what this guy owed. Midnight at the end of the month. Okay? So if you said for the month ending here, that would not be right. That would be wrong. It would tell people you really didn't know what you were doing if you made that mistake. And if I digress about me, it's always about me, right? I've been doing the New York Times crossword puzzles every day for the last 40 years. And I listen to National Public Radio, Will Shortz. Will Shortz is the moderator on radio, and he's the guru of the puzzle. And a couple of years ago, one of the clues was acronym found on a balance sheet, and it was YTD, year to date. Clearly wrong. So I'm kind of a wise guy, and I sent a letter to the New York Times, and I was joking. I said, wow, what a big mistake in today's paper. You must be getting tons and tons of letters. I said, I'm so surprised you guys could be so careless. And I was obviously joking. Would you believe the next day I got a reply from Will Shortz and telling me how much he enjoyed my letter, but he still wanted to defend his answer, which was wrong. And you know what his defense was? He went on the internet and showed me examples where it was done that way. Well, they were done wrong. Anyway, that was my little business there. So we go through the three financial statements. The three phases of accounting: input, processing, output. Hey, you want me to go into chapter 3 and 4 now, or you think we did enough for one day? You're okay,
good.
Lori?
Yeah, that's good. That's a good start.
Any questions?
I do have a question that is not entirely related to what we did, if you don't mind. It's a quick one. I am actually enrolled in financial accounting 230.
Oh, wow.
And I'm starting to think that is not a good idea. I'm wondering if anyone else is taking financial accounting and what their thoughts are, or what your thoughts are about it, because it feels like there's similarities but big differences. And I'm wondering if I really need to get this down before I move on.
Well, Taylor, are you fooling around with accounting 230 right now?
No, I'm just in this class.
How about you, Selena? How you doing? Selena might be muted. Okay, Lori, one thing you said was real true, Lori. You must master this before you go. You should master this before you go to 230. 230 teaches this entire course in about 3 weeks. In 230. There are students who succeed just taking 230. They skip this course here and they do succeed, but many do not. And they drop out right at the beginning and move back to 110.
Right.
So, you know, it's up to you. To me, going to 230 without 110 would be kind of tricky. Just thinking back on my years, you know, going to school 60 years ago, you know. And I'll tell you another thing. When we were in the classroom, maybe the second or third class, there would be a knock on my door, and inevitably two or three people would come in and they, hey Bob, is it too late to sign up for your 110 class? I said, no, come on in, the more the merrier. And they tell me, oh, we were in 230 just now, and we decided to, you know, lower our sights.
Yeah, like I said, a weekend, I'm starting to think that maybe I bit off a little more than I can chew. And I'm also, I'm running a small business. I am the primary caregiver for a 4-year-old, and I'm taking a class. So I think my plate is pretty full. So
yeah, so you can make a decision based on that.
Yeah. Okay. Well, I just, yeah, I don't know how
much
overlap there was, but it sounds like that's going to be too much for now. So thank you for indulging me the couple of minutes. To talk
that's fine. Who's your teacher in 230?
Carolyn Terry.
She's a nasty old goat, ain't she? Carolyn is so nice.
She seems like the nicest person in the world. So
I
yeah.
know, right? She's too nice. Makes us all look bad. You have any questions, Taylor?
No, I think I'm all good.
You think you're following this stuff pretty good, huh?
Yeah, it was pretty easy to follow.
Okay, good. Well, let's hopefully it
Yeah.
stays that way.
I
Selena,
know, I hope so.
any comments, Selena? Anything you
I
want to
did
tell
have
us?
one question, like when you're doing the statements. So like for the month, so it has to be as of the month of, or like for that specific date. That's where I was a little confused.
The income statement and equity statement, you have to say something like for the month of,
Okay.
for the month ending. The balance sheet, it must say as of June 30th, 2019. Because the balance sheet is a photograph in time. It's a point in time. There are no accumulated numbers on a balance sheet. The numbers go up and down each month. The income statement is more of a video, Selena. You're adding one scene on top of the other. Your revenues are going up, up, up. Your expenses are going up, up, up. That's considered covering the entire month, okay?
Okay.
All right. Anybody want to make a motion? We close the meeting?
Let's do it.
Okay. Hey, great to have you here. I'm glad you came in on Martin Luther King Day. Appreciate it. And this video will be up in Canvas and on my website, not my website, on my stupid YouTube channel later on today. Okay. Take care,
Thank
everybody.
you.
We'll see you
Bye-bye.
next week.